Hello, YouTube. Welcome back. Thanks for joining us again. We're going to be doing another financial modeling video on another accruals item. So, for those of you that have joined us for deferred revenue prepayments, this is another one of those items. Work in progress. So, and to clarify, some people might know this as accrued income. Work in progress, I know, can sometimes relate to cost of sales or inventory, depending on what industry and how you what the naming conventions you use are. But for our purposes, work in progress is work completed but not yet billed or invoiced, and it's just allowing us to recognize that work up front as part of matching and ensuring that our reporting provides us the right level of oversight of, okay, we're doing this much work, it's costing us this much to do the work, we can't bill it to the client for whatever reason, but we are still at least showing the performance for the business. It's a very common item in professional services, in construction, pretty much any industry where project type work is being completed and the project will take longer than, say, a month, a month being the typical management reporting cycle. So yeah, it could be a 6-month project. For construction tends to be 6, 12, 24 months, whereas legal matters could take months. Accounting, if you're doing year-end compliance and other types of work, it could be months to get completed, depending on the size of the client and size and the complexity of the client. So this type of work, this type of reporting and modeling just allows us to give us the right view of performance of the company in every period. We're going to look at work in progress. Again, we're going to use our Medano Excel model to allow us to speedily do this, as well as look at the tax impacts as well. So like all our videos, this is to date. This is Aussie centric, so GST is impacted by this, and again, depends on your jurisdiction. It's a value-added tax, so whatever your base revenue is, there's a tax loaded over the top that you collect on behalf of your government. So let's delve into it. We've got our standard base model that we use, our revenue, expenses, balance sheet. Basic balance sheet that captures cash and debtors and all of that. So we're going to look at the basics of how work in progress impacts these three financial statements. So let's get started. We're going to give ourselves a work in progress component or part into this model. So work in progress and our balance sheet work in progress entry. So as it's going in, we're going to just talk about some of the things we need to consider. So if we're recognizing revenue up front, so revenue recognized here, and then we are then invoicing the client post, then we'll note that there's going to be a delay in cash collection. And it could be a significant delay depending on contracts and arrangements. And this is why from a banking perspective, work in progress is actually an important thing that gets tracked. So it's an item that is it often makes up part of professional services type lending covenant packages. It's a way to determine how much cash is being locked up. So lock-up days, or is being kept within the business because of long-dated project cycles. So you'll see revenue at the top. We do our usual mapping, invoicing second, and our mapping as well to ensure that we line everything up. And what we're going to do is let's just look at a project, and we'll keep it simple. So I'm going to use round numbers. So 25,000, 50,000, and 50,000 and 25,000. So let's just say it's a $100,000 project, a bit of an S curve. So, it takes a while to get started, full process, and then completion. Now we're going to then allocate this to a work in progress chart of account. Now you'll see that the chart of account builds up over time. So it's the 25,000, the 50,000, and then the 25,000 that gets recognized and gets built into our corkscrew. If you're unsure what a corkscrew is, check out our corkscrew explainer. But yeah, we're building it up from 25, 75 to 100,000. And let's assume that in this period, we're able to invoice the client. It's just part of the cycle that we've finished it in this month. So 100,000 to usually release, but in this case, to actually invoice the project out. And we'll see that our balances get brought down. And then we now have 25, 75, and 0. So if we then move ourselves over to the financial statements, but before we do that, we're going to make sure we assign this revenue first. Cool. So if we jump into our financials, we'll see that, and we move ourselves over to the right periods, we'll see 25,000, 50, and 25 get recognized on the profit and loss. So we made a profit of these amounts. Now, ideally, there's usually costs associated with this. So, salaries and wages, the more you can assign and allocate costs, the better, or the more accurate you can get your position on what your margins are, how much it costs to actually deliver this work. So net profit gets represented. Now you'll see on the balance sheet, work in progress gets built up. And then once we get to the period where we've invoiced, then our cash is received. And obviously, we haven't put delay on this, so we're assuming that cash gets received straight away. But yeah, for the purpose of just starting, we're going to do the work, do some more work, finish the work, invoice the work, get paid straight away. And then you'll see that the cash received is 100,000 in cash received as part of the actual deliverable or the work or the actual underlying invoice. And then in our case, we have GST of 10% or 10,000, which we're also receiving as part of the invoice, which gets paid or delayed for payment as part of our usual cycle. In Australia, quarterly is common, a month after. I think I mentioned this in other videos, but yeah, quarterly, month post, or 2 months, depending if you have a tax agent. So yeah, this is the broad cycle of how it appears in a set of financials. Now, within WIP, obviously, you can put a lot more detail in this. If there's multiple projects, we can always increase the number of projects or even feed this from another schedule sheet if desired. But yeah, the principle here is capturing the revenue recognition, so what work is completed, and then the invoicing of that work. If we then take this one step further and look at delay on that invoice, so highly unlikely you invoice and you get paid straight away. So if we put an average days delay, so 31 days, so on average it takes us 31 days to obtain the value of our invoices. Single invoice, it's not going to make, there is some leftover in here, but if it was multiple projects, this comes out in the wash, and I think that's the main thing to look at. But for the purpose of this is sufficient. So what we see in this case is the invoice is issued in October. There is on average a delay of 31 days in collecting all these invoices. So by the end of October, we are left with a balance of 110, so our original invoice amount. And during the month of November, we are collecting the bulk of those invoices. Again, we're averaging 31 days. So 31 days on November, part of it will fall through to December. Now, the bulk of this is received. So if we look at our financial statements again, we'll see nothing's changed on the P&L. As with all our accruals, we've already recognized the revenue. We're just dealing with the balance sheet movements and the cash flow. So again, you'll see the balance sheet for work in progress hasn't changed. We now see a debtor because we've invoiced at this point and we haven't received payment yet. So a debtor or an accounts receivable is created. And on top of it, we have a GST payable. So we recognize both of these at the same time to balance the financials. But what it essentially means is we now have the right to collect the invoice for the full 110, but because we have the right to collect it, we also have an obligation to eventually pay that amount to the tax office. So both items get recognized. And now it depends on how you run your cash flow statement, but for us, we do it indirectly. So we have a negative 10,000, which represents the component that the balancing component against our GST. Now it looks a bit funny, but it does reconcile by the time you get to the end of the cash flows. But it essentially recognizes that, for the purpose of this, we should be receiving 10,000. So as part of the GST payable, and we also should be paying the 10,000 equivalent in GST. So this is why both figures come up and they're in the opposite sign, but they do balance out. And then so as we move across time, we've collected our in total 110,000. And then at that point in time, 110,000 has been collected and is in the bank. No more debtors by that point, by December. And then the 10,000 is paid as part of our tax cycle. Again, it's very similar to what we had before. We've now just put the timing delay in here on when we collect all of these values, and ensuring that the cash flow or the three statements balance. So it obviously, we can get a lot more complicated on this one, on how we recognize or how we calculate our work in progress. We can also get tricky around how we invoice, because maybe we don't invoice 100, maybe there's 25 invoice post, and then 50 or the balance of it is done at the end of the cycle. So it does depend on what your invoicing structure is like, or what your contract agreements are. But this is, again, just basic. We have a recognition of the of work completed, appears on the profit and loss, and then we have some cash flow or timing adjustments to manage the collection of one, the recognition, but two, then the collection of that invoice.